So let's take a look at some of the different loans that might be available to a potential buyer, obviously looking for financing to purchase real estate. We're going to be talking about quite a few of them. And like I said before, I can assure you, even though this seems like a lot, and it is, it's a lot of different loans we're going to kind of touch on. It doesn't really even scratch the surface when we talk about all the different types of loans that are actually out there. But these are the more common loans that you need to be familiar with. Again, you're not the lender, right? So do you need to be the expert in all these loans that we're going over? Absolutely not. That's not what the intent or purpose of this is for us. However, you do need to at least have an idea, a little brief description or idea of what each one of these loans do, how they work, why one might be better than another in certain situations. So we're going to cover these loans. Most of them we will not be spending a lot of time on. There might be a couple I'll spend a little more time on just to make sure we understand certain things, but really just some bullet points that you need to remember, because y'all, they may very well ask you or describe a loan or how it works, what it does, what happens when you make this payment. They'll describe the effects of the loan, and you may have to figure out, well, what kind of loan is that, or what kind of loan are they talking about here? So you're going to get questions about it, but again, don't try to think you need to be the expert or know everything about the loan. Just need to know the basics about it, which is what we're going to go over here. And we start with what we call a straight term mortgage. All that is an interest only loan. That's all it is. In fact, most people just call it, I'm getting an interest only loan. But the legal name is a straight term mortgage. Okay? So obviously, if it's interest only, then that means when you make your payment each month, what are you paying? Interest. There's no principal included with your payment. Remember, the principal amount is what actually reduces the debt, right? Where you're paying down what you owe. Well, there's no principal with a straight term mortgage. All you're paying is interest. So if you borrowed $10,000 under a straight term mortgage, and let's say you make payments for 3 years, I'm just making up numbers here, but you made all your payments for 3 years, well, how much would you still owe at that point? $10,000. You still owe whatever it was you borrowed, because all you've been paying during that time is interest only. So again, straight term mortgage is just an interest only loan. All right, does not pay down any principal. Well, now we talk about, there's two types of amortized mortgages that would be available to someone borrowing money. One is called fully amortized. The other one's partially amortized. We'll talk about after the fully amortized. But when you have an amortized payment, that means you have a fixed payment that includes both principal and interest. So yes, you are paying the interest you owe on the loan, but you're also paying at least some amount of principal with each payment that's actually reducing and lowering how much you actually owe. So you're actually paying down the loan. But here's the big difference between fully versus partially. If it's a fully amortized loan, let's just say, for example, you get a 15-year mortgage, okay? Most people get more, like a 20-year or maybe a 30-year. Obviously, the more years you add to the loan, the lower the payment would be, but the more expensive the loan becomes, right? Because you're paying a whole lot more in interest. So, I do try to suggest people try to keep the number of years, like 15 to 20 would be about the most I'd want to go. And if you can't afford that payment, you might be getting too much house, would be my suggestion. But anyway, let's just say in this example, we decide to get a 15-year fully amortized loan. That means as long as I make my payment every month for 15 years, that same payment, that payment's not going to change over the life of the loan, then that would pay off everything I owe, both principal and interest. Okay? Obviously, this is the most common loan you would see, certainly with residential real estate. Okay? Now, one of the things you will notice about these amortized loans, the first several payments you make, in fact, for the first several years in making these payments, the principal portion of the payment is going to be very small. In fact, most of your payment is going to be interest. So you got a small amount of principal that's paying down the debt and a whole lot of interest on these payments. Now, over time, you will start seeing the interest portion start to shrink, where it's a smaller number, and the principal portion will get larger and larger. So over time, you're paying more principal, less interest, but at the beginning, you're paying a lot of interest, in fact, almost entirely interest, with very little principal payment. But it does balance out over the course of the loan. Okay, that's fully amortized. Now, if you decide to get a partially amortized, it's going to work the same way in that you have a fixed payment. It's a constant payment. It's not going to change. Basically, your first payment will be the same as your last. So the payment's not going to change, but here's what is different about the partially amortized. Again, let's say we got a 15-year loan. So they will set the payment so that by the time you've made all your payments for 15 years, you will have paid off all principal and all the interest. But here's the problem. Even though they amortize the payment over, say, 15 years, you're not going to get the full 15 years to pay it off. Rather, they might say, if you were to make this payment, let's just say it was $1,000 a month, you make that payment of $1,000 a month, if you made that for 15 years, that would pay it off. However, they're going to call the loan due in, say, 5 years. Now, I'm using 5 years as an example, but it could be a little bit more, could be a little bit less, depends on the terms of the loan. But once you hit that period of time, let's just say 5 years, that means so you've made payments for the first 5 years. That does reduce some of what you owe, but the remaining balance, which would be another 10 years worth of payments, you still owe that. Now you got to pay all that off in one lump sum. We call that a balloon payment. So if you get a partially amortized loan, that just means there's going to be a lump sum payment or a balloon payment that will have to be paid at the end. So your last payment under partially amortized is going to be a doozy. That's going to be a big check to write right there. So the difference between fully and partially amortized. Fully, you make that same payment from start to finish. There is no balloon payment with a fully amortized. But with partially amortized, you will have to pay a balloon payment, a lump sum to pay off whatever the remaining balance would be. And I will tell you typically what most people do, because they're probably not going to be in a position to make that balloon payment. What they may have to do is just refinance. So they'll get another partially amortized loan, but for the reduced amount, because they've already paid off some, right? Obviously, this is not common at all with residential loans, but it is extremely common and almost guaranteed for commercial loans. If you get a commercial loan, it's probably going to be partially amortized. So fully amortized for residential, partially amortized typically for commercial. All right. The next loan is the home equity loan, or y'all sometimes hear it called a HELOC, home equity line of credit. And these are pretty common. Probably heard of this one before. But Y'all, this is basically where when you can actually borrow money or you're borrowing the equity from your home. That's what you're doing. So once you've made enough payments and you have, say you got $50,000 worth of equity in your home now, well, typically they will loan you usually up to around 80% of that. That number could fluctuate, obviously. They're not going to loan you all the equity you have, but they'll loan you probably around 80% of it anyway. And they call that a home equity loan. So it's basically your money, right? It's equity you own in the property, but you're just borrowing money against it. Now, most people will still have a mortgage, their normal house payment they're making every month. But now, in addition, they take out a home equity loan. So that at that point, the home equity loan becomes a second mortgage, right? You got the first mortgage from where you initially borrowed to buy the property. The home equity loan becomes the second mortgage. Now, if you don't have a mortgage, you've already paid the house off, and now you decide to take out a home equity loan there, then obviously at that point, it's now the first mortgage. But more times than not, it's the second mortgage. All right. So what are some of the other factors here? It does say these loans typically have shorter terms. Normally this is not something you keep for a long period of time. However, home equity loan is kind of like a credit card. It's like a revolving line of credit. So say you get approved for $20,000. So you got a $20,000 line of credit. That's what a home equity loan does and how it works. So even though you've got a $20,000 line of credit, you don't have to use the whole $20,000. You might, you can if you want to. But you might say, well, I only need $10,000 right now to do some home improvements. So you can basically pull that $10,000 out, but you still have another $10,000 you could draw from, right? And as you pay it off, you could pull it back out again, right? So it's kind of like a revolving line of credit. It doesn't go away just because the home equity loan or equity line, it does not just go away because you paid it off, okay? It stays open where you can actually pull more back from it later in the future if you decide to do that. The only way it'll go away is if you close the line of credit, kind of like a credit card. When you just close the credit card or terminate the credit card, then it goes away. But they are usually shorter loans. The interest rate might be a little bit higher than if you get a conventional type loan, but it's a pretty good loan for the purpose that most people would use it. All right. Then there's the reverse annuity mortgage, or the RAM, they like to call it for short. And I will tell you, in fact, I'll tell you right up front, I am not a big fan of these loans. I don't like them. But having said that, all I can tell you is, if you ever decide to take out a RAM, then prepare to get the RAM. That's all I can tell you. I don't like these loans. I don't like them at all. These loans target the elderly. And as you see here, to even apply for this loan, you have to be 62 years of age or older. You must be a senior citizen. So if you're not at least 62, then you can't even apply for this loan. This is just for the elderly. But these loans apparently are used for all kinds of reasons, but here's basically how it works. Obviously it's you're borrowing equity out of your home. That's what you're doing. It's almost like a home equity. In fact, I don't know why somebody wouldn't just do a home equity line instead of this. But in effect, that's what you're doing. But here's the big difference between the RAM and a home equity line of credit, the home equity loan, is, you don't even have to pay this money back. Now, if you do the home equity line, obviously you got to make payments on that. But with a reverse annuity mortgage, you do not have to make payments on it. Now you can, and I would hope you would, because if you don't make payments on it, it's still an outstanding debt. But they do not require you to pay it back unless you move out of the house. So to get this loan, you got to be at least 62 years of age or older. You must obviously own the home and have equity in it, and you must continue to live in that home, right? If anything changes where you no longer live in the home, now you got to pay that money back, or it has to be paid back, okay? So it's not like you're getting free money. It has to be paid back, and typically with interest too. But anyway, and that sounds like it might be a good idea for most people. The problem is, if you die, then obviously you no longer live in the home. That has to be paid. That money has to be paid back, right? Now you might not care because you're dead now if it was you getting the loan, but the people, their loved ones that you were leaving this property to, or thought you were leaving it to, they may not be able to pay that back. They may not have the money. So in that case, basically the bank's going to take the property from you, and get their money back that way. You don't even have to die. You may get in a situation where you just can't live by yourself anymore. Maybe you need assistance in living, and so you move into a assisted living home, or maybe you move in with your children or whatever. But if you move out of that property, that money has to be paid back, and it has to be paid back right then. But as long as you live there, you do not have to pay it back. I would say for test purposes, one of the things I pay attention to, certainly in the question, if they make mention in the question anything about like a senior citizen, an elderly person, homeowner, needing to make repairs on their property, and their funds are tight, and they don't know where to get the money from. Which of the following would be the best types of loan? I promise you it's going to be the RAM, the reverse annuity mortgage. The key terms, keywords to look for is elderly, senior citizens. That's what this loan is all about, okay? And then the next loan is a bridge loan, and that's a pretty appropriate name there. But a bridge loan is it's a very short term, typically very short term loan, but it's money you might need for right now to help you get from this spot to that spot. It's kind of like a bridge to get from here to there, and then you'll pay it off once you get there. You see this a lot in real estate, where maybe you've got a homeowner selling their house and now looking to purchase another house. Well, they want to go ahead and make an offer, and maybe even purchase the second home before their home has sold yet. So obviously until their home sells, they don't have the money to purchase the second home. Well, they might decide just to take out what they call a bridge loan, to be able to purchase the second home while they wait for their home to actually sell. And then once it sells, the proceeds from that loan, from that property, will now pay off the bridge loan, and then they're back to their normal payments again. Okay? But obviously this loan is best used, at least in real estate, if you've got a house you're selling, and hopefully it's currently under contract, and you need to go ahead and close on the home you're buying because you need to get moved out, right? So you might take out a bridge loan to go ahead and purchase that second home until you can get the money out of your primary home. All right. So that's the bridge loan, and hopefully that makes sense to you.